Welcome to Options Prosperity's Options Primer. During this presentation, we will discuss the basics of options investing. This primer will cover the following topics: why invest in options, what is an option, including call options and put options. We will discuss an example of an option. Finally, we will cover some fundamental terms concerning options. Why invest in options? Stocks can do one of three things. They can go up, increasing in value; they can go down, thus decreasing in value; or they can remain the same. Most investors can only earn money on one of these three: the stock going up. Options allow one to earn money no matter what the stock does. For instance, with options, one can earn money if the money goes down or stays the same. Options also provide a means of leveraging your money and to protect your investment. So, what is an option? Options are financial instruments that give the buyer the right, but not the obligation, to engage in a future transaction on some underlying asset. The transaction can be a purchase or a sale. A layman's definition is that options can be thought of as a rain check, where someone can purchase an item at a given time in the future. The only difference is that one must pay for the rain check. There are four major characteristics of an option. The underlying: this is the asset or item that can be bought or sold. For stock options, the underlying would be a stock, such as IBM, or an index fund, such as the NASDAQ 100 or Dow 30. Strike price: this is the price at which the asset item can be bought or sold. Expiration date: the date when the option expires. And the premium, which is the amount paid to enter the agreement. Let's first look at the call option, which allows one to buy the underlying. We have the buyer and seller. The buyer owns the call option. This is referred to as being long. The buyer pays the premium in order to own the contract or option. The buyer can purchase the underlying at the strike price any time before the expiration date if he or she chooses. This is referred to as exercise. Thus, the buyer has the right but not the obligation to exercise the option. Now let's look at the seller. The seller sells the option. This is referred to as being short. The seller receives a premium in return for the contract. The seller must sell the underlying asset to the option buyer at the agreed upon price if the buyer exercises the option. The seller must deliver the asset at the agreed upon price regardless of the current market price of the asset. Next, we'll look at the put option, which allows one to sell the underlying. Again, we have the buyer and seller. The buyer owns the put option. The buyer pays the premium in order to own the contract. The buyer can sell the underlying at the strike price any time before the expiration date if he or she chooses. Now let's look at the seller. The seller sells the option. The seller receives a premium in return for the contract. If the buyer exercises the put option, the seller must buy the underlying asset at the agreed upon price regardless of the market price of the asset. Now let's look at an example. Let's say an investor is bullish on IBM, trading at $128 per share. The investor could purchase the stock or purchase a call option. The September 2008 calls with a $130 strike are trading at $5 per share. Purchasing 100 shares would cost $12,800, while purchasing one contract would cost $500. Each contract represents 100 shares. Both positions benefit from a rise in IBM stock price. However, $500 can leverage nearly $13,000 worth of stock. Next, let's look at how these two positions perform for various stock prices. Let's see what happens if we were wrong in our assumption. We see that at $120 per share, our losses are $800. At $110 a share, our losses are $1,800, while at $100 a share, our losses are $2,800. If instead we purchase the option, our losses are capped at $500. Thus, with options, we can dramatically limit our losses. Now let's look at the losses in terms of percentage. With a stock position, the losses range from 6.25% to 21.88%. However, with a call position, the loss is 100%, even for a small dip in the stock. Now let's look at what happens if we were right and the stock rises. At $130, the stock has gained $200, while the call option has no value. At $135, the stock gains $700, which is where the call option breaks even. At $150, the stock position gains $2,200, while the call position gains $1,500. However, if we look at the percentage gain, we see that the call position doubled in value with only a 9% rise in the stock. The call position quadrupled in value with only a 17.19% rise in the stock price. In addition, the call position earned comparable profits with the stock position. So in summary, from a dollar value perspective, the call position provides a method for limiting the losses while taking advantage of the gains. From a percentage gain or loss perspective, the option position can provide huge gains or losses. Strategies can be employed that reduce these risks while maintaining the profits. We'll discuss these strategies in later presentations. We'll close this presentation with some other fundamental concepts. For most stocks and index funds, each contract represents 100 shares. Three terms describe the strike price in relation to the stock price: at the money, in the money, and out of the money. At the money means the strike price is approximately equal to the stock price. In the money means the option is profitable when comparing the strike price to the stock price. Thus, a call is in the money if the strike price is below the stock price. The opposite is true for a put. Out of the money means the option is currently non-profitable. For a call, this means the strike price is above the stock price. Another concept is expiry, which is when the option expires. For a given month, options expire on the Saturday after the third Friday of the month. When one looks at the available options for a stock, they typically include options whose expiry is the current month, the next month, and others available on one of three cycles: January, April, July, October. The next is February, May, August, November. And the last is March, June, September, December. So in conclusion, options trading is an alternative to traditional investing. There are two types of options: calls and puts. Calls provide the right to buy an asset at the given strike price, while puts provide the right to sell at the strike price. Options provide a method for limiting risk and leveraging one's assets. Thank you for viewing our primer. Please return for more presentations on options investing.